stocks are rallying after another report, this time producer price index, so wholesale inflation, shows that inflation is indeed cooling off. The Dow is up 305 points. The White House says it has even more proof there will not be a recession.
Annual inflation has fallen over the last 9 months. Wages are higher than they were 9 months ago. Incomes are up and consumer spending is strong. Those are the indicators that show us that we are not headed to a recession or a pre-recession. That is because of the work that this president has done over the last 2 years.
At least one Fed president agrees. That is San Francisco's Mary Daly, a non-voting member.
We have businesses that want more workers than they can get. We have inflation that's printing high. So we need to slow the economy to get things back into balance. But slowing the economy when we're on such a fast pace doesn't mean recession. But my modal outlook is we don't have a recession.
Mary, your territory is in charge of Silicon Valley Bank. It could be a credit crisis. But Fed staffers think other than Mary Daly and the White House. March minutes from their meeting showed they're projecting a mild recession, and that starts later this year. Let's bring in Bianco Research President Jim Bianco. We also have SMBC Chief Economist Joe LaVorgna joining us. Jim, Joe, good to see both of you. Jim, I want to start with you. What do you think? Are you modeling for recession this year?
Oh, I think it all comes down to the credit crisis or the banking crisis. Where do you think we are in this? Is it a summer storm that passed? If it's a summer storm that passed, no, we're probably not going to have a recession. We're probably going to have strong growth, sticky inflation, and it's going to keep going high. But is this the beginning of a deposit flight? Is this the beginning of falling asset values in banks? Will they have to pull back on lending? Then, yeah, we could very well have a recession before the end of the year. Now, I happen to lean towards the latter. I happen to think that this banking problem is a bigger problem than people are letting on, and that it's not going to go away. And I'm kind of getting worried about the economy as we go forward.
Joe, would you agree? Is this banking problem not going away? And quite frankly, Joe, I'm kind of sick of talking for over a year now. Are we in a recession or are we not? Or are we headed to one?
We had this, believe it or not, we had a very similar dynamic back in 06 into 07. Where we had various rolling crises, different financial institutions. I believe New Century Financial might have been the first, Indy Bank, names I know Jim knows. And it took a long time finally for that economy to roll over. So Jim's point about concerns in banking, I certainly share. I'm worried that the Fed had raised rates so aggressively. We're seeing a recession already in housing. We're seeing a recession in manufacturing. I would argue that what's happened in the last 6 weeks on the banking side, which to me is not going to get better because the Fed's still going to raise rates probably one more time, and they want to keep rates there. That will encourage this capital flight out of banks, makes the credit crunch more serious and would take a mild recession, which would have been my baseline call, and makes it a more deep recession.
No, geez, deep recession. And the words rolling recession were coming to mind as you were talking, Jim, about all the different sectors being hit. Joe, we got the PPI number, the producer price inflation number today, and I just said, wow. And then I also was like, hello, Jay Powell, are you watching this? Joe, do you think he is? Do you think he listens to what the data is telling him?
I want to help your viewers. The PPI used to be a good series under the old methodology. It's basically useless. CPI we had yesterday, the headline moved lower. The core has been sticky. Measures of inflation expectations and the slope of the yield curve, relative strength of the dollar, all these the weaker commodity prices, they all tell us inflation really hasn't been a problem for 6 months, that if the economy slows, inflation will take care of itself. But I'm not really focused on the PPI.
Got it. Joe, next question. Same question to you.
For Jim.
Oh, yeah. Yes, I agree with Joe that, PPI, I mean, I think you're overstating it. It's less than useless. Remember, a couple of years ago, they got rid of this. They stopped reporting the data and nobody cared before they put in the new series. But to that end, I agree that really the inflation story, actually, if anything, it might be close to bottoming right now. There's a phrase that economists like to use called the base effect. And you've got big numbers from May and June of last year on inflation. 9/10 in May, 1.2% increase in inflation in June of last year, one of the largest months ever. You drop those off, the rest of the year is a bunch of 0.1s and zeros. And so you could actually see inflation bottom in June and maybe start drifting higher towards the end of the year. And the question is, does it make it all the way back down to 2%? Probably not. And then as it starts to drift higher, and we're talking about drifting to 3, maybe 4%, not 8 or 9 or anything like that, the Fed is going to look at that and be very concerned. Now, the only thing that stops that is a recession. The only thing that stops that is a credit crunch from the banks. But without that, we're not looking at the greatest inflation numbers right now.
Joe, tomorrow, big day for the start of the big banks reporting. JP Morgan, Wells Fargo, Citigroup. You know, they're the big banks. That's where many investors nervous decided to put their deposits, to put their money. Can they come out of this unscathed?
Well, they've arguably benefited from the fact that deposit flight has gone from the small and medium-sized firms to the larger institutions. The Fed determines the top 25 banks as being the large institutions. You really want to see what happens on the regional side. But more importantly, we really want to focus on the, unfortunately we get it after the Fed meeting on May 3rd, but the next senior loan officer survey at 2 o'clock on Monday, May 8th will be very important because the credit crunch that Jim and I have been talking about will really be most evident there. Do we see a further tightening in lending standards on commercial industrial loans, commercial real estate, residential real estate, and the consumer side? That's really going to be the focus, and that's still about a month away.
I know. Everyone's talking about commercial real estate, and that's scary right now. We'll have more on that later in the show. Go ahead, Jim.
Yeah, I was just going to jump in and say for the real issue here is banks still offer you 0 on your deposit, your savings account. You can move your money on a mobile phone now in a couple of minutes to a money market fund, and you can pick up 5% yield. So if you've got $250,000, which is the FDIC limit,
right,
you move your money from a savings account to a money market account, you could pick up $13,000, $14,000 a year. That's what's happening. And the money is leaving banks and it's moving towards market-based instruments. So the show's called Making Money. That's the first thing everybody should be doing right now is if you've got any money sitting in a 0 yielding account, move it to a money market fund at 5% and pick up thousands of dollars of interest income. It's easy. It takes you 2 minutes to do it. And in fact, that's what everybody is doing, which is why we're getting worried about money leaving the banks and causing a credit crisis.
And the Fed remarkably missed this. Remarkably missed it. Instead, they're going to overregulate these banks. It's a real sad situation.
Do you really?
You know, that is so important. That's so important to say because the Fed is the regulator of the banks. They get to see the individual line-by-line items. They know all of the books and records we don't get to see, and they still missed it.
Yeah, no.
I mean, I can understand if investors do because we don't see all this data like the Fed does.
I know. I hear what you guys are saying. Unfortunately, we do have to end it there. But if bank earnings show there's very little contagion, I wonder if DC kind of cools off and we don't see over-regulation of the banks. We'll see. Thank you, gentlemen.
Thank you.
Next, we have Main Street Asset Management.